Marianne Elliott from 360 Mortgage Solutions. So today I wanted to jump on and talk to you about credit cards and more specifically, buy now, pay later. So I often find when I'm doing an application for a client, one of the common liabilities they will forget to disclose or not even think of when I'm asking about liabilities is their buy now, pay later. So what I'm talking about with buy now, pay later is Afterpay, Zip Money, any of those accounts where you can effectively purchase something today and then pay it off in installments. Now, the reason a lot of people don't think of it as a liability is because it's almost like the old school lay-by, showing my age by talking about lay-by, but these days most people would be using, and I think you can only get in a lot of places, buy now, pay later accounts as opposed to a lay-by. But the reason the banks will consider it as a credit card type facility is because firstly, a lot of them come with a limit. So if you do have a limit, it means you can spend up to that amount at any given time. And even if it doesn't come with a limit, that is an ongoing commitment that you need to pay. Whether it's for 4 fortnights or whether it's ongoing, you need to commit to paying that. So the bank wants to make sure that after you've paid all of your commitments, you can still afford the mortgage. So what can you do about your buy now, pay later? Well, I guess it's no surprise to say I'm not a big fan of buy now, pay later. In some instances, it does work for cash flow purposes, but majority of the time I find clients are buying things using these accounts that potentially they didn't have the funds for anyway. So I would encourage you, before applying for any credit or home loans or anything of that nature, have a look at your buy now, pay later accounts and see if there's an opportunity for you to pay them out and close them. With interest rates on the rise, we are doing a lot of consolidation loans. So that's where we would look at paying out those accounts and closing them completely to make sure that this isn't an ongoing thing for clients, but also it helps free up cash flow. So I've spoken about this before, but one of the most crucial things to bear in mind when we're looking at consolidating is making sure that the loan term isn't, a 30-year loan term, because you'll end up paying far more in interest in that case. But also making sure that those accounts are in fact closed and don't get reopened down the track. So if you're ready to talk about consolidating loans, or you want to have a chat about buy now, pay later accounts and how it might impact your borrowing capacity, make sure you reach out to Tara and I, and we can run you through that. We also have free Zoom appointments, and I'll pop the link below. Otherwise, guys, that's it from me. I hope you have a great day, and I'll catch you next time.